Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is July 29th of 2024. We're certainly happy and thrilled that everyone could be joining us this week. And I just hope everyone's having a great week so far. Now, as it relates to the market, we've had a choppy 2-week period, right? We talked a few weeks ago how things were, bullish sentiment was fairly elevated. Investors were panic buying into that mega cap tech pocket of the S&P 500, and that we expected to see at some point a major reversal of those fund flows out of mega cap tech and into the rest of the market. Well, 2 weeks ago, we got that. We got that big reversal out of mega cap tech and into the rest of the market. But that negative volatility impacted a lot of investor sentiment because guess what? If everyone's piled into those top 7 names and those top 7 names start to get hit really bad, guess what? You start to get selling across the board in other areas of the market as well. So we saw that weakness last week with our own strategies, right? As the market came down, we came down as well. But the good news is, I think when we look further out beyond this temporary bout of weakness, we actually really do like how the portfolios are positioned because we're not in those bubble pockets of the market. We're focused on other areas where valuation we think will be a huge asset for us. And then also areas of the market that we think benefit as interest rates come down and investors seek stores of value for their money. So we're going to go through those two key dynamics: valuation value, and of course, stores of value as the US dollar and interest rates, we believe, start to come down in the fall. So let's go ahead and get started. The title of this week's presentation is Will the Stock Market Weakness Persist? Right? Makes sense, right? We're going through that stock market correction right now. After the back half of July here being fairly weak, what does August and September look like to us? Right? We know it's a seasonally weak period, so we want to make sure that we're paying attention to those seasonal factors that often hit the market during that time of the year. But then what are some of these longer term trends that are emerging after the weakness? We talked a little bit about where we think we're in the stock market pullback. We don't necessarily think it's over. It's certainly hard to try and time short-term moves in the market. That's not our game. But from a trading condition perspective, we do pay attention to it. But usually you want to see things a little bit more fleshed out. So Wednesday was a great example of a day where that was definitely what we call a multi-standard deviation distribution day. The S&P was down something like 120 points. That's a great example of a day you want to see, but you want to see multiple days like that to really get the fear going, right? And there's still a lot of bullishness out there, especially as it relates to mega cap tech. You just have to watch Mad Money with Jim Cramer to see that. So hardcore defense. And at some point, as these prices continue to move lower, you'll see even the Jim Cramers of the world move over to the other side, right? And that'll be your sign that, okay, now we can get back to our regular playbook. Number two, looking beyond the pullback, what are some of those bigger trends that are emerging? We talked a little bit about that before. And then what works during lower interest rates and deregulation? Does start to seem there's a consensus forming, regardless if it's Trump or Harris, that regulation may have gone a little bit too far. So there's these two key themes. We know interest rates are likely coming down in the form of the Fed. Again, that's not reliant on the outcome of the election. And this broader move of saying, hey, you know what, maybe a little bit of deregulation may help things. Now, what is the setup here? So going into this correction, we talked about this ad nauseum for months on end. You had investors crowd into the same 7 stocks, right? And that creates risk, not just for those investors that are in those stocks. Doesn't matter how great those companies are. Remember, we're not saying anything bad about the companies, right? Google's a great company. Apple's a great company. NVIDIA's a fantastic company, right? Revolutionary company. They're just really expensive, right? I always use the example of, hey, you may like that Model Y Tesla at 30 grand, but at 300 grand, would you still pay for a Model Y Tesla? And the answer, of course, I would assume would be no. And that's the way we look at these stocks, right? Great, fantastic companies, great products that they deliver, and they generate a lot of cash flow, but the valuations are sky high. So we want to be very, very careful around that trade. But when that gets damaged, and the fact that they represent such a huge component of the overall S&P 500, the underlying indexes get hit, right? So then you get investors that are losing money, not just in those 7 stocks, but the indexes. And those indexes represent such a large portion of investor fund flows that it creates that negative sentiment across the wider market. So we have that. Um, Again, that area very expensive in the market. So coming out of this, though, what are we starting to see that set up as? So we have lower inflation, PCE data, which is that data point that the Federal Reserve looks at when they're trying to really figure out have we beaten inflation or not. That came in below last month's reading. So again, in CPI, PCE, all these indicators are showing a consistent trend downward while jobless claims are up. The economy is clearly slowing. The consumer is spending less. Savings rates are coming down. This does, we believe, give the Federal Reserve a green light to start cutting rates in the fall. So if you're an income investor and you're on the sidelines about whether to buy that bond strategy or to consider that protected income strategy through an annuity, honestly, if you are going to do it, regardless if that's with us or another advisor or any other third-party provider, probably good time to consider it so that you can lock in those higher rates before rates move lower. But the bottom line across all of this is our recommendation continues to be to try to sell some of those crowded stocks, mega cap tech, and basically buy the rest of the market, right? So if we look at the S&P 500, buy the rest of the 493 stocks and sell the top 7, right? So that's what we think will continue to play out. Again, what we said before, premature to really call this sell-off a washout. So when we look at the bull-bear ratio, bull to bears, bulls still outnumber bears by a significant amount. In fact, it's still in that 95th percentile. You would want to see this come down at least a little bit. It doesn't have to be a washout event, right? Because that's not something you would want to wait for. Markets will typically bottom before that happens, especially with bull market corrections. If we were in a bear market, it's a different story, right? You would want to look for these 10th percentile readings. But for a bull market and a correction, you at least want to see this come down a little bit. Now, the good news, the percentage of stocks above that 200-day moving average remains elevated. And you may say, well, don't you want to see that come down? No, because the percentage of stocks above the 200-day moving average is a vote on trend, right? So 50-day moving averages, those break easier. The 200-day moving average, 200-day moving average, that's something that's more indicative of long-term trends. So I think the fact that we remain elevated here is a sign of confidence that the trends are intact. We're just going through a short-term washout in the overall market. Tech does remain the center of the storm, as we talked about at the beginning of the presentation. Again, the percentage of stocks above the 50-day moving average. Now, remember, 50 days shorter term than the 200-day. So tech is pulling back. The percentage of stocks in technology above the 50-day moving average has started to come down. This is where we would want to see a washout event because the 50-day represents shorter term moves. So if we got into that 10% reading, that would be like, okay, even though we're not huge cheerleaders of tech right now, we certainly could potentially make some rentals, right? What we call shorter term trades, where we say, hey, some of these tech names are washed out. Let's buy them for a 2 or 3 week rental period and then offload them if we see that the trends are going to revert lower. But right now, we're not there yet, right? And you can see here when we look at cumulative sector ETF flows, the red line is tech, the blue line is the rest of the market. The rest of the market started to benefit a little bit from that tech weakness, but you haven't really seen a significant move out of tech yet. And I think you need to see that before you would say, okay, I'm going to go 2 hands in and start to buy these tech names left, right, and center. We really haven't seen that yet. And that's why we think that we need to be careful within technology. Now, looking outside of tech, I wanted to illustrate this for our viewers and our clients and our advisors and all of our stakeholders. You look at this is the number of trading days since the last all-time high. It's only been 5 days for technology. Okay. The sort of contrast that, look at energy. It's been 2,537 days since energy reached an all-time high, right? 5 days for tech, 2,537 days for energy. Now, energy's in a bit of a spot too, in a bit of a pickle as well, because as the economy slows, demand for energy is starting to slow. So tactically, we've actually been positioning out of energy for the time being. Longer term, we like where the sector is positioned, right? So there's always that dichotomy of, okay, the next 6 months, the economy is going from 4% to 2% or 1% GDP growth. That is likely going to result in some higher inventories for energy. Why sit there and take a 20 to 30% hit on these energy stocks if we can move to the sidelines and buy them back later on? So that's what we've been doing. But just broadly, the point of this chart is to show that most sectors in the S&P 500, from utilities to consumer discretionary to healthcare to financials to materials to staples, they haven't seen an all-time high in years. Okay. And that's the key here. In years. Utilities, 476 days. REITs, 639 days. Healthcare, a major component of the US economy, 642 days. In consumer discretionary, 672 days. So again, most of the market has not reached record highs. The S&P is at an all-time high simply because of tech and to a smaller degree, industrials. Now, as tech has started to sell off, you've seen the money just started to rotate, right? Now, here's another thing. The Russell 2000, 678 days since an all-time high. So look what's happening. As tech has sold off, Russell 2000 relative to S&P 500 has started to break out, right? And you've seen that both on the absolute price chart, which is the top here, and the relative chart. These are sectors and indices that have not seen all-time highs in years. So we think that the move is just getting going. So a lot of this is what's going on in the interest rate market, right? So when you see moves like this happen, big reversals, big breakouts on the other side, a lot of the times you want to look to the credit markets and to the bond markets to try and see if we can get some sort of clue what has sparked this. This is the 2-year interest rate, the treasury rate on the right-hand side. We've had a significant move lower. This is important. We don't talk about the 2-year a lot, but the 2-year is the market's vote on where Fed policy is going. So when we look at the 2-year, this is the chart on the left. This is the 2-year policy rate, and the red line is the 2-year interest rate, which trades every single day, one of the most liquid instruments in the world. The market tends to front run Fed policy. Okay, this is important. The market tends to front run Fed policy. So as interest rates are coming down, this is where the market believes that Fed policy rates are going. And they usually do get it right on the 2-year. Right? I'm not talking about economists and 7 rate cut forecast. All that, that's just baloney, right? Push that off to the other side. You want to pay attention to what the 2-year is doing, right? And the 2-year is making a vote that we're going to get 25 to 50 basis points of cuts in the fall, maybe a little bit more, maybe 75 basis points. First time you're really seeing that in a while, right? So why is this important? A lot of insurance carriers, a lot of bond funds, less so the bond funds, but more the insurance carriers. They price their products based on the policy rates. So if you know that the policy rates are going to come down, it also probably means that rates on certain annuity products and stuff like that, that could start to get cut back as well. So why not front run it yourself and say, hey, if I was looking for some sort of protected income solution, now might be a pretty good time. Or if you're looking for a bond solution, right, our enhanced income strategy, now might be a good time to lock in some of those higher rates. So this is why this is important for us. So as rates move lower and inflation moves lower, what do you buy or sell? We see that. So we looked at the 2-year, the 10-year, similar action, right? This big breakdown. off of the 3-year move higher. What do you buy and what do you sell? So we have two playbooks that we wanted to show you. Our partners at FS Insight put this together, but one is looking at a Trump White House, which of course is more of a toss up. We don't know for sure what's going to happen in the fall. And then looking at, so the first playbook is what benefits and what gets hurt from a Trump White House. The one on the right here, this playbook on the right says when the Fed starts cutting interest rates, what sectors benefit and what sectors get hurt. You'll notice there's a remarkable correlation. We're very confident with this playbook on the right. We are very confident that the Fed will start to cut rates in the fall. The election's a little bit more of a toss-up, right? You wouldn't want to base a strategy on that. But what's interesting is Bitcoin, small caps, regional banks, commercial real estate, M&A, cyclicals, they really do benefit, and we've talked ad nauseum about this, from the Fed cutting rates. That's how we've tried to position the portfolios based on this playbook. You could get this playbook that gets on supercharged if this happens, right? If Trump wins in the fall. Why? Because a remarkable amount of sectors that benefit from lower rates also benefit from the perceived benefit of a Trump White House, which is, of course, deregulation, right? And then what would not do well? Energy and healthcare. Now, I think healthcare is an anomaly. We've actually been buying some healthcare names recently, only because the Biden administration has cracked down on pricing. So deregulation would, in theory, alleviate some of the pricing pressures across healthcare. And we actually think healthcare might be a little bit different this time than it was in 2016 when Trump took his first term in the White House. Energy, we agree with. If you have a White House that wants to drill, well, that means supply is going up, up, up. And that means prices are going down, down, down. So we want to pay attention to that. That's how these are the playbooks that we're using to prepare for the fall. Last time we had a pause, a cut in Fed policy. So in other words, we had inflation, the Fed hiked rates, then cut them as inflation got under control, was the mid 90s, 94 and 98. What happened? Market was already up quite a bit in 94, paused, consolidated, and then shot higher, right? Would not surprise us if we see something similar, right? Hey, we defeated inflation. Now we got deregulation. We got taxes that are under control. It's kind of the green light for risk. Again, there's a lot of theory in this. We'd want to see how things play out into the fall. But just to kind of give investors a little bit of context to what happened the last time we had a hike campaign, a pause campaign, and then a cut with no recession. That's key. We have a recession that changes things quite a bit. But assuming we get a soft landing, that's something we want to look at. Bitcoin, we talked about digital assets being a potential store of value as rates come in and the US dollar is less attractive. We think Bitcoin is well positioned. We have a huge cheerleader in Bitcoin with the Trump administration, but we also see broad bipartisan support to legitimize this space. We know that BlackRock has recently launched ETFs both across for Bitcoin and Ethereum. The legitimization of the digital asset space is a huge story in our opinion, and we want to play that to some respects. So what are the key takeaways this week? Stock market weakness may persist, but we do believe that's largely going to be centered in tech. As money leaves tech, we think that the rest of the market benefits from those fund flows. And then lastly, small caps, digital assets such as Bitcoin, Ethereum, etc., emerging markets, cyclicals, we look at the data, they historically benefit from lower rates. So that's what we got for you this week. 888-543-3776. Please reach out if you have any questions or concerns, but have a fantastic week and enjoy the rest of the summer. Talk to you soon.